Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 1st, 2025. Welcome to March. I hope you are doing well. I hope you had a good week last week, and I hope you stayed safe, and which was a week that was pretty brutal. So I hope you hung in there, followed your rules, and we're going to talk a lot about what coming up this next week. There's some really good setups, so forth and so on. But first of all, I just want to I just want to thank you for coming to this weekend's weekend review podcast of mine, and I hope it's going to be helpful for you. Um, the format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades and all the positions that I have from last week. We're going to talk about when I entered the trade, why I entered these trades, what were the influences, what were the setups, and most importantly, how I am going to manage these trades and these positions going forward. How I'm going to set my emergency stop, how I'm going to set my end of day stop, how I'm going to take partial profits if the market moves in the direction that I want it to, how I'm going to tighten up my stop if we get to trailing stop level, and then ultimately how I am going to exit the trade in full. For me, last week was really good. Um, Very grateful for that. Not all weeks are always great, but I did have some really good setups. So I'm going to share those with you, and hopefully this will give you an idea of how I look at the markets, how I look at setups, how I position size correctly, and then how I manage the trade going forward. Really, when it comes to trading, everyone, you need to be patient and wait for a good setup. I'm pretty good at that. Then number two, you need to position size correctly and have a plan, have a process so that you know exactly what you're going to do regardless of what the market does. It's a real disconcerting kind of feeling just to get into a trade and really not know what you're going to do. But if you have a good plan that incorporates all correct principles of trading, once you get into a good trade that you were patient for, has a lot of setups, then a lot of the pressure's off, especially if you position size correctly. And then you know exactly what you're going to do. And your plan must incorporate that if you're wrong quickly. And if you're right, you have the ability to stay in the trade, because we need to be very patient with our winners and we need to be very impatient with our losers. But unfortunately, that goes against kind of our human nature for trading, because most people, when they have a loss, they're like, well, I think I'll hold on to this. I think it's going to be okay. It'll come back. Really, that's not what you should do. You should get out quickly when you're wrong. You can always get back in. And then when you have a profitable trade, a lot of traders just think, oh, it's good. It's a nice profitable trade. I'll just take it because it feels good to take it. When really that's not what you should do. You should probably stay in it. You should probably risk open profits to make more open profits. I mean, you were right on the trade. More people want to buy the stock than sell the trade. So getting out for no reason is probably not the right thing to do. So, everything that I like, how I trade and how I teach, is about a process of knowing exactly what you're going to do. If then statements. If it does that, then I'm going to do this. If it does that, then I'm going to do, or if it does that, then I'm going to do this. So that's what I'm going to try to teach you, show you with my particular trades today in the podcast. So after we go through all the open and closed positions, we'll see how I did on the trades. Then we're going to talk a little bit about trader psychology. Most important skill, everyone, in trading is it's simply the ability to create a plan and to follow it. Sounds a lot easier than it is because emotions get in the way, but it's always helpful for me to teach it. I hope it's going to be helpful for you to hear it. And by the way, if there's anything in this podcast that is helpful for you or you find valuable, I really would appreciate it if you could hit the thumbs up button or become a subscriber. That would be great. But just show me that you like what I'm teaching here or showing you here, and just hit the thumbs up button. After that, I have gone down through my watch list last night. I do it every Friday night. I go down through my master watch list and I identify some potential trades for next week. Now, these markets, these stocks are not where they need to be yet, because if they were, I probably would have already taken the trade. But I look for potential trades that are, possibly likely to happen next week, and that is what I'm going to share with you. And I hope that's going to be helpful to kind of give you an idea of, to show you how I wait for a market or a stock to come to the location that I want. And if it gets there, great, I'll consider taking the trade. If it doesn't get there, then I'm just not going to take the trade. But if every Friday night or on the weekend, if you go through and look at a chart, it's pretty easy to go, oh, you know what? If that stock got down there, then you'd have this, that, and the other. Those would be multiple confluences. Those would be multiple signals. Is it going to happen every time the next week it's going to get there? No. Sometimes they'll just get away from you, and that's okay. But I promise you, if you do this, you will. There are some markets that will come exactly to your ideal spot, and then you consider taking the trade. But it doesn't mean if it gets to your ideal spot that it is going to be a winning trade. Far from. But the key is, if you wait for it to get to that ideal spot, you have the patience to sit on your hands until it gets to that ideal spot, over time, I'll bet you that those particular trades, you're going to make more money than you lose. If you have a good approach, if you have a good process, and you're patient and you wait for those confluences. So, and that's what, you hear about having an edge in trading. That's it. If you wait for a certain setup and it works 65% of the time, well, 45% of the time you're going to lose, 65% of the time you're going to win. So there's your edge, and that's how it works. So anyway, that's the plan for today. Let's run this legal disclaimer and we'll get going. All right, so hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Well, we've got a lot to get through today. I hope you can make it through the entire podcast. But yeah, I have a lot of positions to show you, which, like I said, I hope that's going to be helpful. And then I've got a lot of potential trades for next week. With the sell-off that we've had over the last week or so, it has given some potential buying opportunities. And in general, people have a hard time buying stocks at a discount because the sentiment's bad, the news is bad. But over time, I mean, if you look back, buying those dips generally was always a good idea to do, but I know it's difficult to do. Traders generally like to buy stocks that are going up and the news is good and the headlines are good. But thing is, the way that I trade, more times than not, when you buy those up there, they're going to come down. So I like to buy things on sale. I studied one-on-one with Dr. Alexander Elder, and he always said, stocks are about the only thing people don't want to buy on sale. They love to buy everything else on sale, but stocks they don't want to buy on sale. Well, we've got some things on sale. And when we get to the portion of the podcast where I talk about the trades next week, I'm going to show you those. But first of all, let's start off with my current positions. This is VIX, Volatility Index. You can see this green band down here. This is what's called an order block, and I have to go all the way back. I know it's hard for you to see here, to 7/12 of 2024 is when we had an order block. An order block is the lowest close before we change market structure to the upside. Then when it comes back to that area, that is where I like to buy. And just, for a general sense here, look what happened every time we got back to the order block. Got to the order block, huge move up. got to the order block, huge move up, got to the order block, huge move up. And then that is why I bought VIX back here on the 19th of February, because it got to the order block. And if you've been watching my channel for a while, I flat out said, look, if VIX gets down to this area, very likely that will be a temporary top in the market. And that's exactly what happened. So I did buy VIX here on the 20th of February. I bought it at $41.60. The confluence of signals, because I always like for a confluence of signal, but the confluence of signal was, one, we were in the order block. Two, we had what is called a V1 entry. Now, I use V1s, I use V2s. If you want to learn more about those, just go to my YouTube channel and the lessons playlist, and you'll see my video there about V1s, V2s. But this was a V1 consisting of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low and closes above bar 1's close. This is an entry. V1s, V2s are an entry signal that I use all the time, and they're really, really quite amazing. So I entered on the 20th of February at 41.60 based upon being in the bullish order block and the V1. Now, as soon as I enter, I want to show you how I position size, because position size is extremely important, everyone. It's the most important thing in trading, honestly. I don't know how you can make a case that it's not the number one thing. So the way that I do it is consist of two inputs. One, how much do I have in my trading account? And two, what is the value of the average true range 2, or the 2 ATR. Average true range just means it's the average range that it's moved over the last 20 days. I take that value and times it by 2, and you can see right now it's 398. So I do this on all of my trades because you need to account for volatility, and using the 2 ATR will do that for you. So two things. One, how much do I have in my trading account? Let's just say I have $100,000 in my trading account. I take 1% of that. So whatever, if you have $1 million trading account, 1% is 10,000. If you have a $25,000 trading account, 1% is 250. So for this example, let's use 100,000. 1% is obviously $1,000. I take the $1,000, divide it by the value of the 2 ATR on the day that I take the trade. So 1,000 divided by 3.98, that would tell me to buy 251 shares. So based upon the current market volatility of this market and the value of my account, it tells me to buy 251 shares. So I have the setup now. I know how many shares to buy. I enter the trade. Now, the next thing that I do right away is I take my entry price minus the value of the 2 ATR, which is 398, and I put it below. That is now my emergency stop. So if I have 251 shares and it goes down $3.98, how much will I lose? 1% of my account. That's it. But the good news is that emergency stop is only going to trigger about 5% of the time. The other 95% of the time, if I have a loss on the trade, it will be my end of bar stop, which generally is much, much closer than the emergency stop. Let's see. Yeah. So I entered here at 41.60. Now, this particular trade is a little different because the emergency stop and the end of bar stop are just about the same location. So this one's not a great example, but I'll show you on other trades going forward. Sometimes it lines up that way, that your end of bar stop is about the same as your emergency stop. So the next thing I do after I've position sized correctly, enter the trade, have my emergency stop, I know what my end of bar stop is. The next thing I do is I take my entry price, which is 41.60, and now I look to the value of the 1.5 ATR. Right now, the value is $2.99. So I take my entry price, I add the value of the 1.5 up to it, and that becomes my trailing stop level, which means if I get to that level, I don't do anything, I don't make a trade, but once I get to that level, now I go into what is called trailing stop mode. And all that means in the future, if I have a close below a previous bar's low, I will exit half the position. And this is a good way to, you hear about tightening up your stop. Well, that's exactly what you're doing, because once it reaches my 1.5 trailing stop level, then I'm tightening up my stop by selling if I have a close below a previous bar's low, half of my position. I want to keep half because you need to risk open profits to make more profits. Okay, so again, we come in the order block and we have a V1 entry, enter 4160. Place my emergency stop 2 ATRs below. In this particular case, it's a unique case. My emergency stop is basically my end of bar stop as well. And if I did get down here, how much would I lose? I'd lose 1% of my account. Then I take my entry, add 1.5 to it. If I get there, now I'm in trailing stop mode. So everything I've talked about so far, as far as position size correctly, emergency stop, end of bar stop, trailing stop level, these are all defensive moves. So in other words, if something goes against me, I'm going to take action. But I also like to play offense in my trading, just like in any sports. You need to play offense and defense. Trading is a sport. So again, everything I've showed you so far is defensive. Now let me show you about the offensive part. I take 10% of the shares that I go into the day with off at 3 different levels each day. And the way that I do it is I take the closing price of the day. Right now, VIX, the closing price is 45.61. So I'm going to take the closing price of the day. I look over here at the value of the 0.45 ATR. Right now, that value is 90 cents. So I'm in this trade. This is what will happen on Monday. I'll take 45.61 plus 90 cents. My first profit target for Monday is going to be 46.51. And if it gets there, I will take off 10% of the shares that I went into the day with. So if I go into the day with 200 shares, I would take 20 shares off there. But I don't just place one profit target, I place 3 each day from the closing price. So the closing price plus 0.45 ATR, which is 90 cents, first profit's 46.51. Then I do it again. I take 46.51, which is my first profit target, add the 90 cents again. My second profit target is 47.41. I'm going to do it one more time. My second profit target, 47.41 plus 0.9. My third profit target for the day is going to be 48.31. And I do this every day. These 3 numbers that I just gave you, I'll program into my trading platform, take 10% off of the shares that I have going into the day, 10% at the first, 10% at the second, 10% at the third. So that's the offensive part, and it's extremely important for me to play offense. It's nice to take a little profit when it's going your way, not all. Remember, just the 10% at the 3 levels. If you have a really big day, maybe you'll hit 3 profit targets. A lot of times you'll just hit 1. Maybe on a decent day, you're going to hit 2. If the stock's down on the day, you're going to hit 0. But you are reducing your position size into strength. You're taking the market, you're locking in some profits. The market can't take that away from you. Psychologically, it works well, and it just makes sense that to take a little profit when the market gives it to you. Okay, so that's it. So here we go. In the order block, V1 entry, entered 4160, emergency stop 2 ATRs below. Also my end of bar stop, trailing stop level. Next day, it takes off like crazy from the entry. So I'm off to a good start. I believe I hit 3 profit targets on that day. So right off the bat, I'm reducing my position size 30%. Also on that day, we got to trailing stop level. So big day to get to your trailing stop level in one day. So I don't do anything because I'm in trailing stop level, but I'm in trailing stop mode, which means now if I have a close below previous bar's low, I get out of half of the remaining shares that I have. Next day, up again, took some more profits off. Next day, up again, hit 2 profit targets on that particular day. And then we go down, but this here on the 26th, we did not close below a previous bar's low. So I held onto all the shares that I had remaining. Had it closed below, I would have gotten out of half the remaining shares. Next day, up again, more profit targets. And then Friday, up again, I hit another profit target before it reversed. So this particular trade doing very well. It's been a nice trade, was never underwater at any point. And because of the profit targets, the way that I take the partial profits, the way this is designed is you will always take something off near the high. And so I took right at the when it was up during the day, I took some off here. So going forward, I am in trailing stop mode. If Monday we close below Friday's low, I'll exit half of the remaining shares. So you can see taking the partial profits was nice. So this particular trade on the VIX, long the VIX, up 8.75%. Let's go to IBB, next trade. Okay, so this is I was just talking about on VIX, I was talking about a bullish order block. Well, this one is a bearish order block, and this one's a little easier. It was more recent. A bearish order block is when you change from a bullish market structure to a bearish market structure, and then you short the rally. So what makes an order block? Well, here on the 5th of February was an order block. It's your highest up bar close before you change market structure. And market structure was changed here when we broke below this low. So we went from a bullish market structure to a bearish market structure. And if you go from a bullish market structure to a bearish market structure, you want to short the rallies. If you go from a bearish market structure to a bullish market structure, you want to buy the rallies. So on this particular trade, again, we have the bearish order block. We break structure to the downside. We rally, and on the day that I shorted, and I shorted here at 138.91, I shorted because, one, it rejected the bottom of the order block. It also rejected the 200-day moving average. And on top of it, it had bearish V1. So I got short at 138.91. I placed my emergency stop 2 ATRs above. My end of bar stop is the high of the order block there. Sorry, I didn't write that line there. The high of the order block is my end of bar stop. You can see it's lower than the emergency stop at about 142.50. And then I place my trailing stop level 1.5 ATRs below. So now if I go down and get to trailing stop level, now I go into trailing stop mode, which when I'm short means that if I have a close above a previous bar's high, I will exit half. So that's the trade so far. I got short, again, 138.91. Next day didn't do much. The next day came down here. I hit one profit target, so I took a little profit off. Next day, another profit target. Thursday, multiple profit targets, 2 profit targets. On Thursday, we actually got into trailing stop mode. Friday, open lower, reversed back up. So now I'm in trailing stop mode. So Monday, if we close above Friday's high, I would exit half of the shares that I have. So this particular trade, doing okay, not great, but up 1.33% on the short side. Alibaba. Okay, this is a different strategy. So I use and I teach 7 different strategies. The first 2 trades that I just showed you, those are bearish order blocks and bullish order blocks. This is what is called an abandoned baby. I know it's kind of a crazy name, but one of my favorite trading approaches that I use and that I teach are abandoned babies and island reversals. They're very similar. Abandoned babies use 1 bar. Island reversals use 2 or more bars. And if you'd like to learn more about those, go to my YouTube channel. I have a video on abandoned babies and island reversals. So the trade I got in here is an abandoned baby. What is an abandoned baby? An abandoned baby is when you gap up and then the very next day you gap down. See how here on the 20th we gap up? So from the close to the open, there was just some really strong, good, positive news. But then right after that positive news, we gap down. So why is that? Well, what's happening here is the market sentiment. The whole key to this trade, the strategy of this trade, is that when you go really bullish to bearish in a very short amount of time, generally going out into the future, if you gap up and then gap down, you're going to be lower. If it's a bullish abandoned baby, which means it gaps down and then immediately gaps up, more times than not, when you look out in the future, it is going to be higher. So the abandoned baby was formed here on the 24th of February when we gapped down. Did I short it there? No, I did not short it there. I could have, but when these babies, these abandoned babies, these bearish abandoned babies happen, usually what happens is you gap up, gap down, and then you'll have a little bit of an attempted rally, and the low of the abandoned baby here, if it rejects that, that's where I like to get into the trade. So on this particular strategy, I don't phase out. I position size the same way, 1% divided by the 2, or 1% of your capital divided by the 2 ATR. But on this particular trade, I like to mix it up a little bit and kind of do a set it and forget it type of trade, where once I enter short here at 139.30 with the rejection of the bottom of the order block, I place a 2 ATR stop above me, but I place a 4 ATR profit target below me. So if I'm right, and this particular type of strategy, in my experience, is right near 75, 77% of the time, I'm going to make twice as much as I lose. So I place a 2 ATR stop, a 4 ATR profit target. If I'm wrong, I lose two ATRs. If I'm right, I make 4 ATRs. And you need to do this in trading. Your risk to reward ratio should be asymmetrical. So you should make more than when you're right than lose if you're wrong. So this is I have an order in to take me out for a loss at 153 for a 2 ATR loss, and I have an order to take me out at 112.10 for a 4 ATR profit target. But like I said, in my experience, this particular strategy works a lot more than it doesn't work, and when it works, I'm going to make twice as much than I would lose. So this strategy, not doing too bad for 2 days. It is up on the short side 5.23%. So that's Alibaba. Let's go to the Qs. All right. So the Qs, I did enter the Qs on the 27th, on Thursday, on the big down day. Why in the world would I do that? Well, this is again an order block. That is the reason that I did it. The order block is back here on the 13th of January. It's your lowest bar close before you change market structure to the upside. When you change market structure to the upside and you have a pullback, I want to buy in the order block. So I bought here on Thursday at $500.60 when it got and rejected the bottom of that order block. So I enter 560 cents, position size correctly like I taught you. I placed my 2 ATR emergency stop way down here. My end of bar stop was a very good risk to reward ratio because my stop on an order block is just the low of the order block. The low was 499.70. So I entered at 560 cents and my stop is just a close below, what did I just say there? 499.70. So it's a very good risk to reward ratio. If it closed at 499.69, I'd simply be out of the trade and lose a very small amount. And in the worst case scenario, I have my 2 ATR stop down here, which how much would I lose if I got there? 1%, right? So I entered 560, 2 ATR stop here, end of bar stop low below the order block at 499.70. I placed my 1.5 ATR trailing stop level above, and in the morning it was down. But I make my decisions end of day, right before the market closes, and we had a nice rally back up. So this particular trade, 1-day trade, pretty good, up 1.53% in 1 day. And after I go through the potential trades at the end of the podcast, we're going to take a look at the Qs. We're going to take a look at the S&P and look for some clues as far as where we might be going. So hang on for that. So those are the Qs. And then on Friday, I did take a long position in Tesla. This is a very good setup. Again, it doesn't mean that it has to work, everyone, but it is a very good setup. This is a deep dip buy setup. I teach this in my one-on-one course. I have a video, a trading series video at udemy.com where I teach this course. The link's in the description if you're interested on that. But this is a high quality trade. Really, a lot of things are lining up. But deep dip buy, when I talk about deep dip buy strategy, we're incorporating either the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI. And one of the best deep dip buy setups that you can have is a day where the price rejects the 200, the 250, or the 300 at the same time that it rejects the 30 RSI. And that's exactly what happened on Friday. You can see on Friday, during the day, we were below the 200-day moving average. Oh, well, I'll get to that in a minute. We were below the 200-day moving average, but we closed above the 200-day moving average. We also were below the 30 RSI during the day. At the end of the day, we closed above the 30 RSI. And cherry on top, we have a V1 entry. Bar 1, bar 2. Bar 2 goes below the low of bar 1, closes above bar 1's close. So that's the trifecta. Under over 200 during the day, under over 30 RSI during the day, and a V1. So I entered at 286 even on Friday. I placed my 1.5 ATR trailing stop level above. My end of bar stop is simply going to be a close below the 200-day moving average. And where's my emergency stop? Well, 37.31 is the value of the 2 ATR. So I take the entry price minus 37.31, right about there is my, I just didn't mark this up before the podcast or when I took the trade, that is my emergency stop. So this is a good example of showing you the difference between your risk to reward ratio on the emergency stop and the risk to reward ratio on your end of bar stop. Yes, here's my 2 ATR stop down here. If it got there on Monday, I would sell immediately. I would not wait for the end of the day. But my end of bar stop is a close below the 200. And you can see that 200 is a lot closer than the emergency stop. That's why only about 5% of the time will I hit my emergency stop, and the other 95% of the time will be my end of bar stop. So I got into this one just a little bit early, and then we rallied really strong at the end of the day. So this one up 2.78% already. So I think that is all of the open positions. VIX up 8.75%. The IBB short up 1.33%. The Alibaba short up 5.23%. The Q long up 1.53%, and the Tesla deep dip buy already up 2.8%. 1.78%. So those are the current open positions. Let's head over to the daily close positions. Now this one was a loss. This is Amazon. I did enter Amazon at 212.20 on the 25th of February. Why? Two reasons. We went under 30, over 30 during the day. And then also we have this long-term trend line channel. If you take the low from here and here, you draw that out, there should be some type of reaction at that level, and that dovetailed again with an under 30, over 30, and that's why I bought it. I bought it here at 212.20. I placed my emergency stop, of course, 2 ATRs below, and my end of bar stop was a close below the channel or a close below the 30 RSI. Those both happen on Thursday on the big sell-off day, so I did have to get out of the trade for a loss of 1.86% on Amazon. And then we rallied back up over the 30 RSI and back over the channel on Friday, but that's okay because I like the Tesla trade better. So this was a losing trade, down 1.86%. And then NVIDIA. I did close out of NVIDIA. This was a really good trade. This was a deep dip buy trade that I took on the 3rd of February. Intraday rejection of the 250-day moving average, as well as an intraday rejection of the negative 3rd ATR channel. Again, this is deep dip buy. Entered at 117.10. My emergency stop was 105. My end of bar stop was simply a close below the 250-day. I placed my 1.5 ATR trailing stop level above, and this took right off. Next day, hit some profit targets. Next day, hit some profit targets. Next day, hit some profit targets. Next day, no profit targets, but got to trailing stop mode. Then the next day, up again, profit target, a couple days sideways. Here on the 13th, up again. Next day, up again, more profit targets. Next day, up again, more profit targets. So I'm selling partial positions into all that strength. And then here on the 21st of February was the first close below a previous bar's low. After reaching trailing stop level, I exited half of the position for a gain of 12.59%. And then we started to move down. Still did not close below the 250-day moving average. And then on the 26th, we went up substantially. I hit 2 profit targets on that day and exited. Why did I exit? I exited because of earnings. Remember, I never hold through earnings. So I exited the rest of the trade because I don't want to go through earnings for a gain of 11.05%. And you can see in this particular case, very good that I exited the position because the next day NVIDIA was down over 8% on the trade. So really great trade. Again, this is deep dip buy based upon the rejection of the 250-day moving average and the negative 3rd. So half out at 12.59%, and the other half exited because earnings were coming after the bell, exited 11.05%. So great trade on NVIDIA. Okay, so those are the 2 close trades. Amazon loss of 1.86 and NVIDIA gain of the remaining shares on the second half, 11.05. Okay, those are all the dailies opened and closed, and now let's go to the weeklies. I also like to trade weekly bars. Weekly bars close on Friday, so I make my decision on the Fridays. So this is an order block based upon, this is TLT bonds. I entered TLT bonds at 87.20. Why? Well, it's an order block. The order block's all the way back here to the 20th of October. Lowest bar close. Then we change market structure to the upside. If you change market structure to the upside, I like to buy pullbacks to the order block. You can see here we got close to it, but never got it. And then it took off. But this one worked like a charm. again, I got long 87.20. Why? Because the confluence. One, we rejected the top of the order block. Two, we had a V1, see bar one, bar two goes below bar one's low, closes above bar one's close. And three, we rejected the negative third ATR channel, which is a deep dip buy strategy. So this is a combination of two strategies, order block and deep dip buy. Entered 87.20. I placed my emergency stop 2 ATRs below at 82. My end of bar stop on this one was a close below halfway of the day that I took the trade at 86.20. So you can see how close my stop was if I was wrong. I placed my 1.5 ATR trailing stop level above. Next week we went up, no profit targets. Next week we went up a little, no profit targets. The next week we went up, I did hit a profit target. Then we moved sideways, no profit targets. Next week, sideways, no profit targets. This week was a big week up where I did take off 2 profit targets, and I am also in trailing stop mode. So this particular trade on this weekly, doing well on bonds with the order block and the deep dip by combo, up 5.87%. So grateful for that. And then last but not least, DDM, which is double leverage Dow short, back to order blocks. You know, there's some time of the year where there's a lot of order blocks. There's other times of the year where there's deep dip buys. There's other times of the year where there's return to value V1s, V2s. Like I said, I use and I teach 7 different approaches. From today's podcast, you would think I only use 2, but I use 7. And by the way, if you would like to learn all the 7 different approaches that I use, I do teach a private one-on-one course in the evening times. I've taught people from all around the world, absolute beginners, all the way up to advanced hedge fund level traders. And I teach them my course. I teach them the rules for all 7 of the different strategies that I use. And I have turned out some good traders. Really, I really have, because I've been trading for almost 30 years, and everything I share with my students is what I've learned and developed over the last 30 years. So if you're interested in doing the one-on-one course with me, I'd love to have you as a student. All you have to do is send me an email. My email is in the link of the description, and then we can start a conversation. I usually like to have a free, just initial get to know you call. It's not a sales call, I promise you. I just want to learn more about you, your trading, if I can be helpful, what your goals are, what your challenges are. And then after that call, that's it. After the call, if you want to get back with me and start the lessons, just contact me. But I love to teach. I love to see my students learn, and you'll have a skill that you can use the rest of your life. So let's get back to this DDM. This is an order block. Back here on the 29th, we have our highest up bar close. And then here on the 20th, we change market structure to the downside. So if you change market structure from upside to downside, what's the move? The move is to then short the next rally. And so I did short DDM at 103.70 when it rejected the bottom of the order block. 103.70. I placed my end of bar stop at 107.53, and of course, as always, I placed my 2 ATR emergency stop above. So the next week, it moved down, recovered. I did hit 1 profit target. The next week did nothing. 2 weeks ago, had a big move down where I hit 2 profit targets, so I took some profits into strength. This week was down a little bit, not enough for a profit target, and I did not get to trailing stop level yet, but this particular trade doing pretty good, up 3.4%. So those are the weekly trades. TLT long with the bullish order block up 5.87, and DDM short with the bearish order block up 3.4%. So really only one losing trade last week, which I'm very grateful for, and it was nice to be long and short as well. So, if you have any comments or questions about any of these particular trades, not sure about something, put them in the comment section, and I will do my best to get back to you. So those are the trades, and let's get on and do a little trader psychology before we start looking for potential trades for next week. Okie doke. So this is from Dr. Brett Steenbarger. He is a world famous trading psychologist, and when someone like that at that level gives you some advice on trading, I like to listen, and you probably should too. So let's see what he has to say. Sitting at a computer each day, not having a concrete strategy for the day, and relying on a vague sense of intuition to get you through is not going to cut it. Yep, that is true, everyone. And I've been there. I have been there. There's certain days where I'm kind of there. But like I've been telling you this whole podcast, if you really want to be a successful trader, if you want to make money over the long run, it really, unless you're some kind of savant and are blessed by God, you have to have some kind of process that you follow so you know exactly what you're going to do. If you sit there at your computer, like he says, with the vague sense of intuition, you're going to be trading with your emotions, and you don't want to trade with your emotions. You want to trade with a plan. I repeat this and repeat this over and over to you ad nauseum because I want you to be a successful trader, and this is what it takes. Get yourself a plan, get yourself a process. You can get it from me. I can teach you how I trade. But if you don't get it from me, get it from someone else. But make sure whatever you're trading has a good risk to reward ratio, tells you to be impatient with your losers and to be patient with your winners. Doesn't matter if you're trading monthly bars, weekly bars, daily bars, 5-minute bars, 1-minute bars, it's all the same. Be patient for the entry, good risk to reward ratio, and have a process. Please get yourself a process. And whatever process you get, make sure that it does incorporate good risk to reward ratios and having the ability to make a big upside trade and have small losing trades. In trading, having a big win, obviously that's fine. Having a small win, obviously that's fine. Break even trade, totally fine. Small loss trade, totally fine. You're going to have them all the time. They're just a cost of doing, but your losses are a cost of doing business and trading. But having big losing trades, that's what's going to hurt you. That's what's going to make you lose money in the long run. So whatever process you find, make sure that it does not allow for that. And if you do that, that's it. I have a student that we're starting with on Tuesday, and his name's Steven, and I told him, I said, Steven, if you follow what I teach you with these 7 different strategies, if you follow it and do what I teach you, you're going to do just fine. You're not going to make money on every trade, but over the long run, you're going to do fine because you're following the proper rules of trading. But if you start thinking that you are smarter than the market and you start trading impulsively, that's where the downward spiral can happen. And I don't want that to happen to you. So get yourself a process. Sitting at the computer each day, not having a concrete strategy for the day and relying on a vague sense of intuition to get you through is not going to cut it. And it won't cut it. And I have a feeling that when I read this, some of you are going to go, oh, yeah, that's me. That's me. So don't let it be you. Don't be that 90% of people that lose money trading. Be the 10% that make money and take the money from the other 90% by having a plan. All right? Okay, let's get to the potential trades for next week. And I always mention this before I get into this. Here I have 8 potential trades on the daily time frames, 8 potential swing trades on the daily time frames next week. They're not where they need to be yet, but if they get there, I might take the trade. But it is conceivable that all 8 of these could trigger on the same day. So does that mean I'm going to jump into all 8 trades? No, I'm not. If all 8 of these trigger on Monday, I'm going to pick the best trade. And how do I do that? Well, I give each setup a score, like a report card. If it has 1 entry signal, I give it a point. If it has 2 entry signals, I give it 2 points. If it has 3, I give it 3, and so on. The one at the end of the day that has the highest quality score, that's my best bet to take that trade than the others. right? And what do I look at? I look at risk to reward ratio. I look at the confluence, how many confluences, combinations of signals as well. I look at higher time frames. So I look at, if I'm trading on the daily, I look at the daily, but then I'll also look to the weekly to see if there's some other signals or other supports that are happening there. And then I also look at the relative strength of that particular stock compared to the market. Maybe, I have 8 trigger, but the market was down. Well, maybe out of this 8 here, maybe one of them was up. Well, that has a higher relative strength. So that would get me off the fence to pick that one instead of the other one. I'll give you an example. I was trading day trading yesterday, and Tesla was much stronger than the rest of the market. In the morning, the market was red, but Tesla was green. So it's like, I'm going to concentrate and look for trades on Tesla today because why? It had a higher strength. And actually, let me show you. This might be a good time to show you this. So here's Tesla. Let's go to the 5-minute. Okay, this is the 5-minute on Tesla. Here is your order block. Here is your lowest bar close before we change structure to the upside. So this becomes your order block. So I bought here. Why? Again, here's your lowest bar close. We change market structure here. At the end of this bar, we are inside of this order block. Look at that. I bought there, sold it about there. That was a great trade. But again, why? Because it was much stronger than the rest of the market. So that's relative strength. So if you're day trading and the market's down, look for a stock that's up. Look for a stock that's bucking the trend. Because if the market turns around like it did on Friday, that particular stock is much more likely to explode higher faster when the market turns around than the rest of the market because it was stronger to begin with. Make sense? So anyway, sorry, I took kind of a tangent on there. But again, I'm going to wait for the highest. I'm going to look if these all triggered on Monday. I would look for the highest quality score and take that one. And this is what I teach all my students in my one-on-one course: the ability to give a score to each trade. So if you have multiple candidates, how to pick the best one. So I'd love to hear from you. I would love to have you as a student. I will teach you everything that I know, and all you have to do is just send me an email. The course is 15 hours, by the way. It takes a while. It's a serious course because I teach you all the rules for 7 different strategies. I teach you. We run simulations. I want to see you doing the trading so that I know that you're trading it the right way, because when you're done, I want you to be the best trader. It's very important to me that my students become very good traders and have that skill. So here we go. AMD. All right. AMD is a potential. I have been watching and tracking AMD for a long time, everyone. A long time. And look how it just goes down and down and down and down and down. Well, all the way back here, you hear me talk about order blocks, all the way back here, 1031.23. This is where an order block was. So I am looking for an order block, and we are in the middle of the order block. Also, I have this channel here where I connect the low here to here, draw that out into time. Look at that. That's exactly where we bounced. And in addition to that, we are in the order block. We had a little V1, but I did not take the trade. Tesla was better. But what I'm looking for on Monday, from a deep dip buy, look, we're at 29.31 RSI. So if it closes on Monday above the 30 RSI, that's my entry signal. But it's a nice confluence of signals. 1, we're at this channel line, which we've already rejected. 2, we're in the order block. That by itself is a big thing. So for me to get long, right now it's 29.31. If it closes above the 30 RSI, that's my signal. And That's the confluence, right? I mean, I could have gotten in on Friday with the rejection of this channel line, right? But remember, Tesla rejected the 200-day moving average. It had a V1. It rejected the 30 RSI, so it had a higher quality score than AMD. So that's why I didn't take AMD. But AMD is very oversold, and it's in a very big area of support here, but I can't anticipate it. I want to wait until it closes above 30 RSI. If it closes above 30 RSI, then it's a combination signal of a deep dip buy, channel trend line rejection, and an order block. So you see how I weave all three of those together. So if this closes above 30 RSI on Monday, I'm certainly will consider getting long AMD. Caterpillar, okay, well, we are back to order blocks on Caterpillar, and this order block goes all the way back here to 9624. You can see as Caterpillar got close to this order block, that's right where it stopped going down, right? No coincidence. So I want to get a rejection of the top of that order block there at about 335.44. Hasn't done it yet. I've been waiting for a long time for this, but still hasn't done it. But just goes to show you having patience. So I might miss it. Caterpillar just might take off. It's extremely oversold. I might miss it, but again, if it does go down and reject 335.94, possible entry for me on Caterpillar. Salesforce.com, CRM. Well, big fall here, obviously, but we are down to some important levels. This is deep dip buy strategy. Look, 200, 250, and 300-day moving average all nesting right here. On Friday, we did go under 30, over 30. That's a deep dip by signal, but I really like to take confluences of signals. So I did not take that trade. Again, Tesla had a higher score, but next week, if we do continue down and we reject that 200-day moving average and also maybe reject the 200 and the 30 RSI, it's one of the highest rated signals that I have is an under 200, over 200, under 30, over 30. So that's what I'm looking for. I'm looking for the 200-day moving average. And I was talking about multiple time frames as well. Look, I drew a line at the 200. I drew it at 289.30. Let's go to the weekly and see what that line looks like. Look at that. On the weekly, the 200-day moving average dovetails almost perfectly with the 50 SMA on the weekly. That's what I'm talking about, multiple confluences of time frames. That's strong to have a big support on the daily and a big support on the weekly. So that's what I'm looking for next week on CRM. It's rejection of the 200, 250, 300. One of those are all nested there together, and or rejection of the 30 RSI. That would be the best. So that's what I'm looking for on CRM. DoorDash. Okay, DoorDash, I'm looking for a short. Why? Order block, bearish order block. Here we have our order block. This is on the 14th of February, Valentine's Day, highest up bar close. And then here on the 25th, we closed below the pivot low. That changed the market structure to the downside. So if I have a downside market structure, I want to short the rallies. The high and the low of the order block is 214.64 is the high, 204.86 is the low. If we go up and reject the bottom of the order block on a closing basis, that could be a potential. I also am looking here at 206.10 as an area of rejection. Why that? Well, one, it's in the order block, and two, see the big down bar that we have? If we reject halfway of the big down bar, that's going to be some resistance. So if it just plows up through them, I'm not going to short. If we go up and we reject the trend line that's above us, I may short there. Or if we go all the way to the top and reject the high of the order block, I may reject there. So just because it's in the order block doesn't mean I'm just going to go ahead and short it. I want to see a rejection, either the low of the order block at 204.86 either halfway of the big down bar, 206.10, rejection of the trend line that's above its resistance, or rejection of the high of the order block at 214.64. So I know that kind of maybe might sound complicated to you, but I'm looking for rejection. If it just keeps going up and not rejecting anything, then I don't want to get in for the short. I want to see a rejection of the key level. But a lot of key levels are dovetailing in this order block, bearish order block. INDA, my gosh, this thing just goes down like crazy. We had the low here, the low here. We drew the channel line out, didn't hold that. We're under the 30 RSI. What I am really, but we have these massive bullish divergences on the MACD. We have divergences on the RSI. We have divergences on the ATR channels. So really what I am looking for here is either a close above the 30 RSI. Right now it's 26.73. But really what I'm looking for is a gap up on Monday. If we gap up on Monday, then this will become a bullish abandoned baby. And that's a strong signal. So that's what I'm looking for on Monday, is a gap up from Friday's close, making this an abandoned baby, and maybe that will be the low. We'll see, right? I'll place my 2 ATR stop, I'll place my 4 ATR profit target, but look at INDA, folks. Look at this move down. Is there ever going to be a bottom? I don't know. I mean, eventually, I'm sure, but I'm waiting for the signal, and the signal is either to close above the 30 RSI, but really what I'm looking for ideally would be a gap up, making Friday an abandoned baby. Let's go to Netflix. Netflix, okay, order block, bearish order block here on the 14th, highest up bar close. We changed market structure last week to the downside. I'm looking to short either the bottom of the order block or the top of the order block. The bottom of the order block is 1,041.69. The high of the order block is 1,064.50. So I'm looking at the low and the high of the bar on Valentine's Day for a short, because we have changed market structure from up to down. I want to short that rally. Let's take a look at silver, SLV. Okay, this one's pretty simple. This is a deep dip buy. I'm looking for the 200-day moving average. The 200-day moving average is also dovetailing with the negative third ATR. And we had a 50 cross, other one. Just those two. So the confluence of the 200-day moving average and the negative third ATR channel. You can see last time we tested the 200, you got a nice trade out of that. Will we get it again? I don't know, but I'm not going to touch silver unless we intraday reject the 200-day moving average, bounce at the 200-day moving average, or close below the 200 and close back above. And then last but not least is Walmart. Okay, so Walmart had this huge run up. We did change structure to the downside. Here's the order block on 213, highest up bar close before we change market structure here. Is it going to get there? I don't know. But if it does, I would short it, right? I'm looking for a rejection of the low of the high of the order block. The high is 105.25. The low is 103.53. So, it's quite a long ways away. I don't know if I'll get the chance, but if it does, I will. One thing I wanted to show you too. Look, I talk about channels. The low here, connect those lows out, go out into space. Look where it bounced to the penny. It bounced at that channel line. That's why I like these channel lines that are drawn out into time. Look at that, just to the penny, and then we had a bounce. I didn't take the trade, but just showing you these channel lines really are no joke. And combining them with other things, order blocks, deep dip buys, things like that, like on AMD, is important. That's why I'm looking at AMD. So that's Walmart. Not likely that it's going to get there, but if it does, look for a short. Okay, so those are the dailies, and let's talk about the weeklies. Got a few of those. Okay, here is AMD again. AMD showed up on the daily, but it's also showing up on the weekly. Why the weekly? Okay, On the weekly, we're in an order block, and here is the 300-day moving average, not far below. The 300-day moving average is 96.97, so it's a couple dollars below. This is a combination trade of a deep dip buy and an order block. Whenever I see a major moving average like the 200, 250, or 300 in an order block, I'm interested. And that's almost where we are. Again, on the daily, if we close above the 30, that might be my signal to get long and trade it on the daily. However, if we go lower and don't close above the 30 on the weekly, looking at the 300 week moving average, if by Friday we had gone below it, closed back above it, or bounced, then I could get long on the weekly. So it depends. If it goes up, I can take it on the daily. If it goes down and then rejects this 300 week moving average, I can take it on the weekly. I mean, it's extremely oversold, but you don't just buy something because it's extremely oversold. But if it's extremely oversold and you get a legitimate signal like these on the daily or the weekly, that's really what I'm looking for. So I'm going to watch AMD closely on the daily and the weekly. Let's go to Anheuser-Busch, Budweiser. Nobody wanted, nobody wanted, nobody wanted. Everybody wants it. Okay, so what am I looking for here? This is a fair value gap. A fair value gap is a gap that happens when you change market structure. The fair value gap is from 63.95 down to 59.28 is the shortable area. The real key that I'm looking for here is the halfway at the big down bar on the 11th, on the 1st of November. See the big down bar we had? Big down bars indicate that there's a lot of selling happening. So therefore, if you come back up and reject the halfway of the big down bar, that would be my potential short area. Rejecting or shorting 61.70. That's about all I'm looking for on this trade next week. That sometime it went above it and closed back below it, or touched it and closed below it. That would be my potential short on Budweiser, because one, I'm shorting halfway the big down bar, and two, I am shorting inside of this bearish fair value gap, which is the bearish area anyway. Let's go to INDA again. That's showing up. Again, I'm talking about on the daily, looking for a gap up to create a bullish abandoned baby. However, if it goes lower, look what we have on the weekly. We have the 200 way down there. But, you know, if you would have told me back here that you'd be getting the 200 anytime soon, I would have thought, yeah, it's not really likely. But if we go back in time, look here. Last time we were at the 200 on the weekly. Was there some good upside potential? Holy smokes, I would say. Well, folks, we are getting close to that again. It doesn't mean that it has to reject it this time and do what it did last time, but with this kind of sell-off, I would imagine there's potential for a lot of buyers at that 200. And then mainly, what if it rejects the 200, it gives you an extremely good risk to reward ratio. Above the 200 week moving average, I'm long. Below, I'm out. So that's what I'm looking for on the weekly on INDA. McDonald's, okay, I'm looking for a short. Here's our highest up bar close before we change market structure on October 18th. Well, we are back in the order block. So why haven't I shorted it yet? Because it hasn't rejected anything. If it had rejected the top of the order block, I may have shorted it on Friday, but it did not. So I'm looking for a rejection of the high of the order block essentially next week. So it would have to reject the high of 315.28, and if it did that, I could get short. Then I have a very good risk to reward ratio, because if it closes again above 315.28, I would just get out. So this is a good example of it changing market structure to the downside, being in the shortable area, but not giving a signal yet. Just because you're in the area doesn't mean you short. Okay, I'm looking for a rejection of the top or the bottom of the order block. Let's go to Merck. Merck, okay. I talked about buying Merck in the bullish order block. Do you remember that from a couple weeks ago? I never got the chance. I didn't take the trade 2 weeks ago because I didn't like the risk to reward ratio, so I missed the trade. But it does go to show you when we're talking about these order blocks, look, where did it bounce? It bounced exactly in the order block. I was just a little bit too precise on my trade and I missed it, and that's okay. However, there is an order block above us, highest up bar close before another market structure change. That the low of that order block it dovetails perfectly with this 200 week moving average. So there's your confluence. So what I'm looking for next week, if we continue up and reject the 200 week moving average, I would get short. Makes sense? Because one, it's rejected the 200 week, and two, now it's inside a bearish order block. So I have a feeling Merck is going to trade somewhere between the low of the order block, of the bullish order block, to the high of the bearish order block. But really good example for weeks. I said, look, if Merck gets down into this order block, likely a bounce, and that's exactly what happened. Unfortunately, I didn't take the trade. But now we are coming up into a bearish order block. But I like the bearish order block in conjunction with the 200 week moving average, but it would have to reject it and close under, and then my stop would just be a close back over the 200. Okay, Tesla. I already took Tesla, as you know, on Friday with the rejection of the 200, the V1, and the under 30 over 30. However, on the weekly, if on Monday we close below the 200-day moving average, I'm going to have to get out of the position, take a loss. However, if it keeps going down, we have the 200-week moving average down here as potential entry. The 200-week moving average is at 247.67. That's still a long ways away, but who knows? We could get there, and if it does get there, that would be an excellent long-term good risk to reward ratio to buy Tesla. So hopefully it doesn't get down there, because I'm long on the daily, but market doesn't care if I'm long, so it could close below the 200, and if it does, then I'll turn my attention to the weekly and see if we can get rejection of the 200. United Healthcare, UNH. Okay, well, United Healthcare has been really beat up with some of the news and so forth and so on. But what I'm looking for on United Healthcare is a rejection of the 200-week moving average that is above. That dovetails with the breaker here. That dovetails with a bearish fair value gap. So we'll see what happens. But I'm going to key off of the 200, which is 486.70 next week. If we reject that and close below, I could potentially get short there. Real estate, XLRE, well, real estate's had a big move up, obviously because interest rates have been going down. But what I'm looking for, and is it likely? I don't know, possibly, but I'm looking for a short of this order block. The high is 45.48, the low is 44.32. It was your highest up bar close before you change market structure to the downside. Therefore, if we go up and reject the bottom or the top of the order block, the low 44.32, the high 45.48, I would look for a potential short on XLRE. And then last but not least, XLU, which is utility sector. Again, bearish order block. Here we have our order block on the 29th of November, highest up bar close. Then we change structure to the downside. I want to short the high or the low of this order block. The low is 81, the high is 82.93. Interestingly enough, I'll put another level in there at 81.30. Why 81.30? Because that is the halfway of the big down bar here, which should incorporate some kind of resistance there as well, plus being in the order block. So that's what I'm looking for on the weeklies. So before we end, let's take a look at the indexes a little bit, and I'll give you some potential levels to look at that are quite important, I believe, at this moment. Of course, I am long the Qs because of the order block, but let me show you something. When we look at these channels, we connect the bottom, go out in time, see how we did not respect it. We closed right below it. So now this trend line above is resistance, okay? Okay, now we have a lower trend line. We have this pivot point, we have this pivot point. We run those out into space. We broke that. So now that is going to be resistance. And you go lower, you take the longer term trend line of this low and this low, you run that out into space. On Thursday, we broke that low. So what I want to point out to you now is we have 3 bearish trend lines above us, everybody. And so Monday, if we go up and we reject that trend line above us, that could be a short-term high for the moment, right? So I just want to show you that there are definitely some, I mean, this is a big down move. If we go straight up, I'll eat my hat. Really, I don't think it's possible. So we are running into some levels of resistance on Monday, probably about 511. That's about $3 above us. And that's also going to dovetail with about halfway the big down bar here. So I'm just saying technically we have a lot of work to get back up. I don't think we're going to do it. I don't want to give an opinion, but if I have to be honest, I don't think so. But some of the biggest rallies that you have are in extremely big bear markets. But be aware of these trend lines above us. Like I said, about 511. Next one's going to be about 525. Next one up here, 439. But yeah, I think it's possible if we rally. I mean, at the best possible scenario, maybe we get to 520, maybe. But I guess the reason I'm telling you the major one right now is this first trend line above us at about 511. So be careful for that. You know, a lot of times when we have rallies, people say, okay, finally the bottom's in. I don't know if the bottom's in, everyone. I kind of doubt it. I'm not saying we couldn't get a rally for a few days, but we are coming into some really heavy trend lines above us, and these things really do matter. So just want to kind of give you that warning to look for those particular levels next week. So I hope you enjoyed today's podcast. If you did, I know it went long, I apologize, but if you did, I would appreciate a thumbs up. If you could subscribe, that'd be great. If you could try to go out and do something nice for somebody today, I would really appreciate that. It'd be nice if we all did one act of kindness. If you could go out and do one nice thing for an animal, they appreciate acts of kindness as well. If you'd like to be my student, I would love to have you as my student. I'll teach you everything I know, 15-hour one-on-one course. My email is in the link in the description. Just send me an email. If you're interested in a really good online video course on the Deep Dip Buy, I have that in the description as well. For the Udemy course, 9.5 hours of video just on the Deep Dip Buy strategy. It's a great one. I showed you a lot of Deep Dip Buy trades today. So anyway, thanks so much. If you made it through, thank you so much. I know this today was long. So have a great weekend. Please be careful next week. Personally, I don't think we're out of the woods, so be extra, extra careful. All right. And if you have any comments or questions, just put them in the link below or in the description below. All right. Take care, everyone. Have a good rest of your week, of your weekend. And we'll talk to you next weekend, hopefully. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice. and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate